All right, today we have a very interesting stock to analyze, and that is Broadcom. Ticker symbol AVGO. Broadcom is one of the major players in the semiconductor design and manufacturing space. So we want to take a look at this company to see, number one, is it a quality business? And number two, is this business priced at a particular valuation that we like to get in at? So we're going to look at that right now. So let's jump right into it. Broadcom. The interesting thing about this company is Apple announced a multi-billion-dollar deal with them for them to make components. So they've been making wireless components for Apple. And also more recently, they announced that Apple is going to start developing their own AI chips to reduce their dependence on NVIDIA. So they're going to do that with Broadcom. So looks like there's going to be a long-term, long-lasting relationship between these two companies. And we'll see if other companies do the same thing as far as try to take dependence off of NVIDIA, because they don't want to be dependent on one business for their operations, especially when it gets to more proprietary issues and designs when it comes to AI. So that seems to be the trend with these companies, Google, Microsoft, Apple, making their own AI chips. But how that's going to play out, we'll see. But we see Apple is definitely trying to depend less on NVIDIA. Doesn't mean they're not going to have NVIDIA chips. I believe they more likely will. However, they're trying to reduce that dependence. So that's the interesting thing about this particular company. Let's get right into the chart. Right now trading at about $168 per share. Slight downtrend as of late here. Coming down to that 168. Had a high of about 248 a few months ago. Trading at a market value of $795 billion. That's the market cap. Interesting here, their beta is 1.03. So not as volatile as other tech stocks and semiconductor stocks. They seem to be right in line with the market. So that's a good note right there. PE looks to be high at 78.3. We'll evaluate the company to see if this valuation is too high. Earnings per share, 2.16. Forward dividend yield. So they have about a 1.4% dividend yield, $2.36 looking for the next 12 months. So let's break down this business to see if this makes sense for us to invest in. So the revenue and margins. All right, so we have revenues, 6.8 billion in 2015 up to 51.4 billion in 2024. Looking at the trailing 12 months, they're at 54 billion now. This is 3/4 of 2024 and 1/4 of their 2025 year. So not a significant thing to look at there, but just to note that's their trend. Their fiscal year ends at November 30th. So we do have their first quarter of 2025 to look at. One thing to note, they've had 3 years of single-digit growth over the past 10 years. Every other year has been double-digit growth. So that's a great sign for them. The semiconductor industry, you got to understand, is a very cyclical industry. We're in a boom right now because of AI, but over the past 34 years, there's been 9 periods of contraction in the semiconductor business. So about 24% of the time, there's going to be some downtrends in that industry. So you have to understand, as far as being a long-term holder, when we hit those cycles, you got to understand these cycles in this industry are pretty short term. And when new technology develops, it's a quick turnaround to where you hit an increase. I wouldn't say a boom, but I would say an uptrend expansion in the industry. But looking at this company, when they experience some of this contraction, they still are able to grow. Even though it's single digit growth, they're still growing. So averaging 18% over the past 5 years. The revenue trends look solid. Gross profit, 3.5 to 32.5 billion last year. One thing I love to see, increased margins. 52% gross margin, meaning for every dollar that they bring in, they were keeping 52 cents after they cover the cost of their goods. After they deliver the product to the customer, 52 cents now to 63 cents. So every dollar they bring in, after they deliver their product to the customer, they're holding on to 63 cents. That's a pretty solid margin. Not as high as NVIDIA's when it comes to the semiconductor design, but they also manufacture. So that's something to note about right there. That's really solid for a manufacturing company. 63%. So revenue and margin trends look solid. Let's look at net income. 1.3 billion to 5.8. So let's look at this. Break this down a little bit more. We have 1, 2, 3 years of negative growth. All right. So only 1 year of loss in 2016, but the other years they made profit, but their profit dropped. Remember, this is a cyclical company. This is a manufacturing company. So they're going to have some heavier investment into the company from time to time in R&D that's going to decrease their profit. Doesn't mean they're not going to be profitable and not continue to grow, but from 14 to 5 because of certain types of expenditures that they have and the timing of those things. So understanding this is a cyclical business, however, the company is performing well. I mean, margins, again, they're kind of all over the place. However, the cash flow is growing, as you'll see next, and the revenues are growing. So, and the margins are continuing to improve on the gross margin side. So these numbers will continue to climb up, but they are still going to be kind of staggered along. So that's what to expect with this type of business. Let's get to the free cash flow. 1.7 billion to 19.4 billion in 2024. Now, when we're talking about free cash flow, this is the number that I believe is one of the most important numbers when it comes to analyzing a stock. And here's why. The free cash flow is the cash from their operations, from running their business. They generate cash from selling their product minus the capital expenditures. Capital expenditures represents the required reinvestment back into the business. So once they paid all the bills that they're required to pay to keep the doors open, pretty much, reinvest in the infrastructure of the business, what's left over? That is the free cash flow. Free cash flow is important because this is where the dividends are coming from. This is where the mergers and acquisitions money is coming from. This is what they use to pay down their debt. And this is what they use to repurchase shares in the long run. So the free cash flow is what I believe is the most important number when it comes to the operations of a business. So again, 1.7 to 19.4, no years of negative growth. So every year it's gone up. And only 1 year has it been single digit growth in 2023. Every other year it's been growing. So we love to see the free cash flow with a very strong trend. Annual growth rate over the past 5 years, 16%. Over the past 3 years, 13%. So a little bit slower more recently, but still solid and growing. So we like to see that. Now let's compare that free cash flow to their debt. How fast can they pay off their debt with the cash that they're generating from their operations? Because payoff is one of the main things free cash flow is used for. So 2015, 3.8 billion, 2024, 66.2. So that's a large increase. So at first glance, that might look bad. However, let's look at their cash flow. We saw that their cash flow is growing consistently as well. So they keep their debt at a reasonable level regarding their cash flow. They can pay off their cash flow in less than 5 years. We like 3 years is a great position to be in, but 5 years is great. 3 to 5 years is what we're looking for. Past 5 years, they've averaged 2.9. So on average, they can pay off their debt in less than 3 years with the cash flows that they're currently generating. So this is a great position, great leverage position for them to be in. We'd love to see that as well. Now, this company does have a dividend. Let's take a look. Currently, they're paying 1.32% per share, 59 cents quarterly, and the payout ratio of 49%. So there's two great things about this company and the positions of their dividends. So number one, we look at the payout ratio, 49%. That means when it comes to their free cash flow, 49% of their free cash flow is paid out to the shareholder in the form of a dividend. That means they have a lot of runway to grow that dividend over time. So when companies are sub 50, we're looking at potential range for high dividend growth. So this could be a dividend growth stock for your portfolio based on that. Number one, they're growing their free cash flow. Number two, they only are paying out 49% of that to the shareholder currently. So that's a great sign. The second thing we want to point out is that actual growth rate. Look at this, double digit growth rate, 11.3, 14.1, 12.2, 13.8, 10.7, 22.6. So since 2019, they've been growing their dividend at a double digit growth rate, which is amazing. So this company has been in a high dividend growth state over the past few years. And I believe this trend is likely to continue because of the growth of the AI industry and the fact that free cash flow is strong and growing every year, year after year. So this looks to be like a strong and smart dividend growth investment in a particular industry that's one of the fastest growing right now. So that is something that I believe is significant. Most of the time when you're investing in an AI industry that's pretty new and it's kind of in the boom state, there's so much rapid reinvestment that the opportunity for a dividend growth in that space is typically not there in those newer spaces, but we have one here. So a history of strong dividend growth and also payout ratio sub 50, looking for a company like this to continue to grow that dividend at a fast pace. So the dividend is amazing. It might be the number one reason to invest in a company like this. So let's look at the value added. We want to know, is the company increasing their economic value by keeping the doors open and running their operations? So how do we look at that? We look at the returns on capital. So we want to see, when it comes to your debt and the equity that you have on your books, how much money are you getting off of that? This is the money that you have to use for your business. This is your financing. So we want to see, how much money are you making off of that? We want to know how efficient management is. And we want to know, compared to the cost of that capital, what is the interest on that debt? And what is the opportunity cost of holding that equity and using it for your business instead of something else? So we look at the weighted average cost of those two items and we come up with 5.9. So they have a return on capital of 18%, 5% or 5.9% of their cost of capital, which means they have a spread of 12.61. That means they're creating economic value at the rate of 12% a year. That is a solid rate. And this is the 5-year average. So they have a solid trend there. Let's get to the valuation and see what we think about this business. So they're estimated to grow at 19%. I use a discount rate of 10% for a company like this. Their cost of capital could be used at that 5.9%, but I like to add an equity risk premium to at least use 10% on all my discount cash flows. And if I were to buy this company today, I believe that I can expect at least 25 times their free cash flow amount as far as the market cap of the company at that time. For reference, they're trading at 41 times free cash flow. If I buy now, I believe I can at least get 25. With that said, with those inputs, we're looking at an intrinsic value of about $150. So they're trading at about a 10% downside right now. But I want you to understand when I'm doing this, when I do intrinsic value, I call out a price, but that specific price really isn't my target. My goal is to get to a ballpark number of what the fair value could be, because we're using assumptions. All of these could be wrong, or like, we don't know. Yeah, we want to be safe, but we don't know what's wrong in our assumptions of the future. We want to be reasonable and believe that they're safe assumptions, but we don't know what's going to happen. So therefore, we go for a range. In the fair value range, I like to use a 10% plus or minus from my intrinsic value. So I have a 135 to 165 fair value range. Now, with that said, let's say we're using that 165 range, they're trading at about 168, 169. So barely above the fair value range. So we have to understand, if we're going to buy a stock at a premium, that stock has to be a quality stock that we're okay with buying it at a premium. So with all the things that we looked at, is Broadcom at a premium right now, or worth this few dollars of a premium, like slight premium? Are they worth that? And I believe the answer is yes, because of their strong cash flows, because of their high dividend and dividend growth rate that they're paying to the shareholder. I believe this could be a great stock as far as a buy and hold investor. This is a company that, when it comes to those cycles in this industry, this is one of the companies that aren't really heavily impacted by those cycles like some of the other chip manufacturers or chip designers are. So with that said, I believe this is a quality business, and that 169 or that 168 is not a bad price at all to buy and hold this stock. However, I say this because I believe Nvidia is a stock that is number one, trading at a better price right now, better valuation. and growing at a lot faster rate than what this company is growing right now. So yes, this is a good stock, especially if you are looking for a one that's in that space and you have that dividend growth that you need for your portfolio. However, overall, I believe NVIDIA might be a greater investment or a better investment for most people just because of the faster growth rate and currently the better valuation. So that's my opinion on Broadcom. Let me know what you think in the comments, and I hope to see you in the next video.